right, so commodity trading is all about risk. If you don't know me and if you are new to this channel, my name is Damien. I've been in commodity trading my entire career for more than 15 years now. And this is a bunch of pictures of me. You can see, look, this young pal, yeah, trying to close deal. But anyway, so this is me. I've been physical commodity trading my entire career, and this is my background. All right. So what are all of those companies that you see here? What do they have all in common? Some trade petroleum products, some trade grain, some trade foodstuff, and so on. But what do they have all in common? What do they have all in common? They de-risk the transaction for their counterparties. All right, it's very important to, before I speak about risk, you need to understand this point, which is extremely important. Commodity trading firms create value by de-risking. All right, they create value by de-risking transaction for their counterparty. Let's take a quick example and then speak about all the different type of risk. Let's say that you are a Chinese manufacturer, a Chinese factory. You want to buy some minerals in Nigeria. What is the riskier? To trade directly between the two of you, or to go through a trading company that may have like an office in Shanghai, an office in Hong Kong, and an office in Singapore? For you as a Chinese company, obviously, would you want to prefer to deal with a company that has an office in your country? The same for the Nigerian supplier. Do you feel more secure to trade directly with a Chinese company or with a company, maybe a Singaporean company or even a Hong Kong company? All right, you know that if something goes bad in China, I mean, it's dead, man. No, it's dead. If something goes bad in Singapore, there's still ways to make your money back, man. If the guy tries to steal from you. So, and obviously, usually mineral trades, I mean, depend margin will be 3 to 4%. So for 3 to 4%, what do you prefer? It's a real question, and this is why you understand that the commodity traders create value by de-risking the transaction for their counterparties. Most important thing that you need to know, a lot of you guys, if you are new, you need to know that matching supply and demand is zero. In today's world with WhatsApp, everyone knows this data about everything. Everyone knows everything, what everyone is doing. So matching supply and demand is not enough. It has no value. We are in 2025, but the value now that commodity trading firms have is by de-risking the transaction for their counterparties. All right, let's review the 3 big type of risk. The first one, we are going to see everything which is related to market risk. Then we are going to see all the type of risk which are related to counterparty risk. And finally, jurisdictional risk. Please note that I've regrouped the type of risk I've regrouped those a lot of type of risk behind those behind. No, trying to say something in English, but it doesn't work. Anyway, so there's like those 3 big risk type. There is a lot of risk below that, and this is what we have done. But obviously, there's no rules about how do you name the risk and what are they. It's just me, just with time, that I come up with that type of categorization. That's the word that I was trying to look for. Categorization. All right. So let's dive in. Boom. Market risk. So first thing, market risk is all the risk related to price moving. Obviously, the most obvious one, the one that everyone knows, is price risk. Commodity prices move up and down. So if you buy oil today, tomorrow, it's probably going to be another price. There is like, obviously, you can mitigate this risk by hedging your purchase or your sales, depending. So, but a lot, I mean, a lot of commodities, of raw materials, ingredients have no hedging possible. There is no future market where you can hedge your risk. So in that case, there's other ways. I mean, the contract, how you structure the contract is going to be how you can mitigate this risk. But know that obviously the big commodity, the big commodities, sugar, wheat, copper, oil, whatever, there is a way to hedge the price risk. But for the rest of all the other commodities, there is no way to hedge it. Second risk, market risk, the basis risk. So the basis risk is basically when you hedge your product, then the difference between the spot price and the future price is what is called the basis. So, all right. So let's say that the spot price is 100. All right. The future price is 98. So the basis in that case would be 2. So 2. Okay. So the basis is a difference between the spot price and the future price. So when you are hedged, you still have a risk, which is the basis risk. So now imagine that for whatever reason, I don't know. Let's speak about wheat. Okay. All right. Your wheat is hedged. All right, and it's going to come from like a specific area in the US. But for whatever reason, there is like a train crash in this area in the US, or there is a massive fire or some logistic issues. In that case, the wheat in that area is going to spike up. The wheat market, the future wheat market, is not going to move because this area is too small. But if you had a deal with this area, I can tell you that the basis is going to shoot up also. So if you are hedged, you are going to lose money. So all right, so basis is going to be the risk of basis is basically you cannot really do anything about that. Maybe I'm wrong because I haven't really traded enough with commodity that are hedged, but I think there is no real way to mitigate the basis risk. But the basis risk is basically real. This is the risk about the spot price that you have compared to the future. Then interest rate risk. This one is about the price of the money. So I'm not sure this one can kill a company, but it can really hurt the profitability. Very simple example. Let's say that your competition is the big firms, and that their cost of the money is 1%. So 1% per year, something like this. It's very low. When the rate is really low, they are going to be able to borrow money at a 1% per annum rate. All right. Let's say that for you, this rate is not 1%, but it's 4%. So okay, all right. So the delta is enormous. It's like four times more expensive for you to borrow the money than for them. So now let's say that the interest rate spike up again, and now for the big. It's good. Okay. So now let's say that for the it's very low. Let me. This sound is always shitty. All right. So now let's say that for the big firm, the price spike up to let's say the interest rate increase again to 5%. And for you as a small firm, now it's 10%. So obviously it's way more expensive than what you used to pay, let's say 4, but it's only double of what you used to pay before compared to the other firm. So really important interest rate. The risk is more about hurting your profitability than anything else, but it's always there. Now let's speak about counterparty risk. So this is the second big category of risk. So the first one is, the one that everyone is going to speak about is going to be the credit risk. Basically, when you give the product to someone and he has time to pay you, then this is what we call credit risk. So there's two big ways to mitigate the credit risk. Obviously, the letter of credit or basically any type of bank instrument, you can mitigate this credit risk, or credit insurance. In those two ways, basically what you are moving the risk of credit from your buyer, from your counterparty, to the bank in the case of a bank instrument, or to the insurance in the case of credit insurance. So credit risk, if you work with big enough company, there is always going to be a credit. Most of the time there's going to be a credit insurance possible on them, or they will be able to issue quite easily a letter of credit. Counterparty risk, fraud risk. So this one is very, very important, especially in international trade, because in international trade, it seems like people doesn't see. It seems that people feel like, how can I say? They feel like they can cheat on you as you are not in their country, that they will be protected somewhat. So be extremely important. Be always very careful with who you deal with. There is a lot of scam going on with fake document, wrong grade. They're going to scam you on the product. And obviously, do a real due diligence. No BS paper, it means no bullshit paper. It's like when you do your due diligence on your counterparty, don't rely on papers. Go physically and go check what people are saying about this counterparty and so on in the market, because this is how you do real due diligence. Because papers, everyone can fake them. And someone that will want to scam you and if he knows well how to do it, you will not see that is producing wrong documents and so on. Performance risk. So this is the risk that a counterparty fails to meet the terms of the contract, such as delivering substandard goods, late shipment, or not delivery at all. Okay. So performance risk is basically everything which is related to the contract. If the guy do not perform the contract. So one way to mitigate this risk is basically with a performance bond. So what you are going to a performance bond in a short is basically most of the time is going to be a standard letter of credit, which is going to be drawn if there is some issue with the performance. So obviously, when you ask someone to issue a performance bond for the contract, is going to be quite heavy, honestly, to do that. And it's people are not going to issue performance bond or to do anything performance bonds related if you're not a huge company with like a huge amount traded. The people don't do performance bond for like very small amount because it's a headache. It's not that easy to put together. But yeah, performance risk very important. There's always a lot of issue with contract. With physical commodity trading, you deal with real life, so there's real problem. But still. Now let's speak about the third big type of risk, jurisdictional risk. So the first one is the biggest one is sovereign risk. The risk that a government action impact the ability of a counterparty to fulfill its contractual obligation. All right, if the government ban the export of some product, or I don't know, jack up the tariff so big that it makes no sense for the people to export or whatever, then we can call it a sovereign risk. And against that, actually, there's like some type of insurance that you can also subscribe. But usually, those type of insurance is more for like big project. If you are going to build a factory for 500 billion, and then in a country you're not sure, you can take an insurance on that country. Contractual risk. So this is a risk that the counterparty does not honor the terms of this contract due to ambiguity, dispute, false claim, or bad faith of action. So this is not the same as performance risk, even though it's quite close. This one is the fact that the guy is going to try to screw you on the contract. So obviously the way to mitigate that is to know your counterparty. All right, because there's like it's so easy to make false claim or to use like force majeure where there is no force majeure. Force majeure is always a clause in a contract. Then you say, let's say, it rained so much, it's a case of force majeure, and so on. So there's like a lot of ways that you can just basically screw your counterparty on the contract if you are of bad faith. Jurisdictional risk, there is a ESG risk. So this one, I can tell you, like now that Trump is running the US, I haven't seen anyone talking about ESG no more. So I think this one is dead. Nobody cares. So ESG stands for economical, societal, and I don't even remember. All right, it's all the green shit basically. Then reputation risk. So there's some. Let's say that there's some company that are owned by what can I say, by the son of a politician, right? The son of a president. All right, some company will not be able for reputation risk or for compliance risk to deal with that company because they don't want to be mixed if there is some type of fraud or some issue in that country due to the president. All right, so some traders will take the reputation risk when other people won't. Jail risk, some traders, they don't care about going to jail, so they will take the jail risk when other people won't. Yeah, so basically this is just to tell you that there's a lot of different type of risk. I would say there's even like an 100 different type of risk when you deal with international trade. So it's important to know them and like to understand that basically when you are a commodity trader, there's a risk you can change it by game. So in which type of game do you want to play? Some people want to play the speculation game, so they want to speculate on the price. They think that they can know better than the market where the price is going, so they will speculate on that. This is what would do a hedge fund or whatever. Then there's sovereign game. Some people, they know very well one country, so they know that there is not going to be any issue for them, or they will know how to solve an issue in a very difficult country. Some people do play the credit game, so they will finance their customer because they know for whatever reason that this customer, even though nobody wants to finance them, they can do that safely. Fraud game. So again, some people they will deal with the quality, so they know they work in a very difficult countries, for instance, where people always try to fraud, to sell you subpart shit, but you know how to deal with that. This is why you are good. So you are going to play the fraud game, or let's say the quality game, jail game. Otherwise, some guys they don't fucking care. You know, they they will do illegal shit, and yeah, they don't care. So this is what this is a game that they play. So again, each time there is risk, you can basically put game on the other side, and this is a game that the commodity trading firm is playing. All right, that was a very short presentation, only like 15 minutes, and now we have 15-minute Q&A. And by in 15 minutes, I have to go because I have another call. All right, let's talk. If you guys have any question, shoot. Let me talk all the question. Hello, SSM. Hello, Paul. Hello, Son. Christopher. Hello, Christopher. Hello, Christian. Hello, Yasmin. Hello, Willie. How do we say your name? Joyce? Joyce Drew. All right, let's take the first question. Very informative as always. Damien, thanks. I have 3 newbie questions from starting from scrap. All right. 1, is LC back-to-back still possible nowadays? All right, so LC, well, okay, so for people that don't know, LC back-to-back means that you receive an LC from your buyer, then you ask your bank to reissue an LC, basically using the same term of the first bank to your supplier, obviously at a higher price, at a lower price, so then you can make the mixture. So is LC back-to-back still possible? So purely back-to-back is going to be difficult. Sometimes the bank will ask a little bit of collateral, but in some cases it is, like, for instance, if you work with a local bank and they have local clients, the bank, if you are a good customer of them, they maybe can do back-to-back LC, but it's very narrow. It's always a very narrow narrow possibilities. Like, I don't see a bank. I haven't seen, like, in 10 years a bank doing back-to-back for like international trade. Usually, the only way to do that is when you do local trade. Second question: 25% advance, is it common? Yes, it's quite common. Scrap trading without scrapyard possible. Big players might be exporting without traders today. Yes, yes. I mean, but we are doing scrap trading without scrapyard, and yes, margin is small, but there's a lot of small type of scrap that you can make better margin, because there's a lot of shit out there. So if you know buyers that are willing to pay more for what the junkyard is doing, yes, for sure. And also a lot of junkyard, they don't know all the product that they collect, and they collect like hundreds of things. So yo Olivier, how are you doing, man? So greeting in London, it's quite easy to get general business funding, 100K unsecure, and then equivalent of your home credit. It's a question or what? What is the period after a small niche company? No second, I'm just trying to get then I will go back, Paul. Then, is it the same story in Switzerland, or do the bank not give you shit about? All right, so this is the question of Olivier. Basically, he said that it's quite easily to get 100K unsecured. I'm not sure this is the case, but I can tell you that if that is the case in the UK, in Switzerland, it's very, very difficult. It's very difficult to get anything unsecured, especially to do international trade. So no, Switzerland is shit. Paul. So Paul is my business partner in Comba Energy. What is the period after small niche commodity trading company reach break even? Should be right away. I mean, the first year should be break even, man. What about transferable LC? Yeah, man, I've seen this. It's like, I think transferable LC is like a legion, you know, like something that people talk about. But I've never seen that. And I've seen like on some bank document that you can tick transferable LC, but I don't think that it's possible. Maybe, I mean, used to be the thing back in the day, but now seriously, I haven't seen one bank that allows transferable LC. I know Damien will drop you an email after the call. I'm a second student. Yeah, sure, man. Okay. What is the cheapest payment instrument? The cheapest, man, Paul. You know it. It's the TT. It's a transfer. But then payment instrument. I don't know, man, because there is a lot of payment instrument. But usually each time you need to use an instrument, it's going to be expensive. So, but yeah, so I don't know, man. I don't know. It's depend bank to bank. I have no good answer to that. Hi, Damian, in your experience, what is the most current issue that you face? The reality is depend really the market. This is what I said in the presentation. Is like, for instance, what I do in South Africa, everything is going to be about quality control. Because honestly, finding clients is not really difficult. It's about like, okay, all right, can you make sure that you are going to get the quality and the quantity that people want in a country which is like imploding, like South Africa is. So it's very difficult to work there. So yeah, so I will think the issue is really it depends. It depends a lot. It depends on the trade flow and what you do. Appreciate. What are the terms for a company obtaining a letter of credit from the bank? What do you mean? What are the terms? Man. Great presentation, proceeding short and sweet. I believe some basis risk will be mitigated by marine cargo insurance. You need to have a true financial interest in the identifiable goods. So, are you sure about that, man? All right, you mean that there is a margo? Okay, that you can insure the basis with your cargo insurance. Yes. Yes, this is possible. But I mean, my question, Christian, maybe you know it better. Is there like a way to? No, there is no way to insure the basis. Like if the basis just go negative and you are losing money on the basis, is there like a way to mitigate that? Maybe there is some structured product that I don't know, but yeah, you can insure that. Yes, I'm pretty sure. What the payment tab you mostly use, and how do you put trust when you do advance payment? And all right, payment term usually it's prepayment. We mostly work on prepayment, and then the trust. But the trust is you go there, you go there, and it is no trust, and you need to verify what you are doing. Thank you so much. No worries, dude. Hey, Damien, what is the best international energy trade market? London. What's the question, man? What the question? The biggest firm there in Geneva, but yeah, I'm not sure I understand the question. How does perform guarantee works, man? A performance bond, man. Ask ChatGPT performance bond, but usually it's something. I mean, it's like a LC. It's like an open LC that is drawn if there's issue with the performance of what is written on it. It basically works as an LC. I ran out of character earlier with the first message. Sorry. Yeah, sure, no problem. But man, you have access to Neo Phoenicia, man. If you have like any question, I think we have a call with Neo Phoenicia on Monday, if I'm not mistaken. Let me just check. Yeah, Monday. If you want to come, Monday at the same hours. But you probably work, yeah. Levitation. Sorry, I joined late. So the question may be unrelated. I have no experience in commodity trading, but I have many contacts on the supply side across the globe. Is there money to be made brokering? No, there is not. There's not, man. A lot of people try that days, but man, there's not. Is it possible to establish a good business as a sourcing agent before shifting to being a trading agent? Very difficult. Very, very difficult. Because what is your... it's like the same as brokering. It's like, what is your value, man? If you are sourcing agent, but you know the guy that you are buying from, like is your friend, you can really mitigate the risk by using you as a sourcing agent. Why not? And even like that, man, I'm not sure. Hey, Damien, about performance bond, the base amount for it would be relevant. Not try to understand. If scrapyard don't know what product they are dealing with, how do you consolidate them? Working with good partners who can collect quality scrap? Yes, that would be it, man. And you know, man, if you need to do one container of something, it's very small, man. It's very small. You can like put it in your garage if you have one. It's not if you need a place to consolidate. Thank you for the video. Hey, Damien, about performance. Yes. Okay, performance. What deal size is relevant to be talking about? Like, I don't know, multi-millions, I guess. Before that, it's a lot of fees for what? Do you small firm trade paper for hedging purpose? Yes, I don't. I try to avoid actually, but yeah, yes, I know some guys that are alone and they do the hedging by themselves and so on. What's the payment step you mostly use? Prepayment. How do you put trust in your? I already answered this question today. I don't put trust. I don't put any trust in. I verify. Is there a way that create insurance for the client to pay, or is it just in case of insolvency? No, they will not force. Okay, credit insurance is work like that. Let's say that you give to your client like 30 days to pay. So then after you give 30 days. Then the credit insurance will ask you to notify them after 90 days, right? So in 90 days, the guy doesn't pay, you notify them. Then after 120 days, I think you need to notify your client again that said that now it's going to be called an insolvency, and then the credit insurance is going to take over. In credit insurance, they're just going to put some fucking lawyer on the back of the on the house of the client and get the money. I have a buyer is ready to pay 20% in advance, like 70% against document, 10% okay. Are those payment term friendly? Is a new customer, no relationship before, man. Man, honestly, you may lose 10% of it, so be careful. It's not friendly, but man, if this is a new guys, I would never accept like 20%, 10% upon arrival, unless it's a really big company, well known, and so on. Because in some countries, man, people they are like specialized to give you like 5% or whatever, and then this money never arrives. Do you rely on reporting agencies such as the Platts, Fast Market much in your company? I haven't heard you talk about them much. What do you see them pro and con of this data? No, man. Of course you have to, man. I don't speak about that because it's double stake, man. Double stake, yeah. Basically, it's like yeah, man. You have to. I don't know how to say, man. You need to know what are the prices in the market that you deal with. So you need to use them. Oh man, I sorry guys, I have like so much question, but I have another call like in 2 minutes, so I will take as much question as I can. And you know what? I will do another call same time next week, Sunday, same time. I will do another video call. How do you know BGN International, man? Is it the only energy trading company? Man, company in Turkey? No, there is a lot, man. There's a lot. Metropet, Transpet, it's the one that I know, but I'm sure. No, there's a lot. Thank you for the clear answer. No problem. Hey, Damien, can I ask you about how would you approach coffee? Approach a coffee chat? What do you mean? In terms of deal size? Yeah, multi-million, I said. I plan to work as a transactional attorney and consultant. I'm interested in maritime finance, logistics, and I have developed interest in commodity. Any advice for me? Transactional attorney, and what is that, man? What is a transactional attorney, man? I don't even know what is it. For a startup, what advice you can be if you're just about to obtain the LC from the bank? What must have the document for both sides? Yeah, man. Make sure that okay, or on the LC you need to put all. Okay, all right. There's two sets of documents. There's a set of document for the export and a set of document for the import. So you must make sure that there's all the documents for both sides. Don't scrapyard get paid 100% upfront? Did you successfully negotiate, or did they just accept partial payment? Yeah, some okay. Usually scrapyard they have a very low cash flow, so they will always ask for 100% upfront. But some they have better, so you can negotiate. You can negotiate, actually. You can always negotiate, but usually they will prefer 100% upfront. Is profit margin, if the profit margin is 30%, then if he's lost, yes, 10% is okay, yes, but man, we are in trading, so 30% is not really realistic. It's possible, but if a small player don't trade paper, how do they sell risk? How would you approach paper trading? Hey guys, I really have to go. I'm very sorry. Thanks a lot for 40 people. It's a lot. So let's do this next week, same time. I will do another live. I'm not sure about what, but yeah, I will do another one. And thanks a lot for all of you for being here. 40 people, like it's a lot. Thanks, guys.